Hey, John, how are you today?
Great, Elliot. We were able to have the arrival of our first granddaughter, Lucy Marie. She was born yesterday, Owen's now baby sister. So everybody's doing great. So we're really excited about that. Whatever else is going on in the world, these kind of things are just what it's all about. So really happy about that.
Well, congratulations to you and Sue. I have two granddaughters, and I can tell you granddaughters are lots and lots of fun.
Yeah, she can't wait, and yeah, everybody's excited.
That's good. Where would you like to start?
There's a lot out going on internationally as well as domestically. So let's just jump around a little bit. I saw a piece in a publication called FinTech Global. The title is UK law firms hit with a record AML fines in 2025. According to the report, a sharp escalation in enforcement actions against UK law firms over AML failings. And again, with regulators there handing out some of the largest fines to date. One of the highest penalties of the year came in March. The firm is Simpson, Thatcher, and Bartlett's London office was fined £300,000 following a review. This U.S. firm was found to have longstanding weaknesses in its control framework, including the absence of a compliant firm-wide AML risk assessment. So that was definitely interesting, and that story also talks about a couple of other items in terms of the fines and penalties.
Yes, for our audience from the US who isn't familiar with the UK rules, unlike the US, law firms and lawyers are subject to the UK's money laundering regulations of 2017, which requires them to do a risk assessment, CDD, and other things. As you pointed out, the largest fine was leveled the London office of a US firm, which is interesting. Maybe the US will ultimately catch up on the gatekeeper side, but not yet.
Yeah, right. In Switzerland, the Money Laundering Reporting Office in Switzerland, MROS, issued an updated typology report. It's the 30 pages of things that we always talk about, sanctions evasion. There's some real estate related cases in there. There's also on various criminal organizations. Even though it is based in Switzerland, obviously these sorts of reports have value far beyond their own jurisdiction because it gives you some clear-cut examples on some of the things that law enforcement and AML officials are seeing in their jurisdiction. So again, it's a free download. It is the MROS report from Switzerland, just issued late last week.
I saw that, and two things caught my eye. First, they had a section called Focus on Enablers, and attorneys showed up there too, so a little bit of a through line. And then there were two different case studies related to life insurance. And we don't talk a lot about life insurance. Way back when the Patriot Act was passed and the number of entities that fit under the definition in the Bank Secrecy Act of financial institution, they added insurance. And as you recall, there was a big debate about were the underwriters, the life insurance companies actually going to be covered, or was it going to be the agents, and how was that all going to work? I just thought it was interesting that the Swiss report had several topologies related to life insurance, which we don't talk about a lot.
Again, staying internationally, an area that we've spent a number of webinars and podcasts on, and that's dealing with antiquities. UNESCO has issued a report. There's a virtual museum now of stolen cultural objects. So, a very interesting posting by the folks from the Antiquities Coalition. According to the note, every 4 years, they put together an agenda, and the agenda for this year included the launch of this virtual museum, a call for the UN to add culture to the Sustainable Development Goals, a release of the global report on cultural policies that offers recommendations on protecting artists and cultural heritage at risk while bolstering resilience, peace, and security. So you can either get that on the UNESCO website or through the Antiquities Coalition.
I also saw something that caught my eye, and that was that Rabobank's head of financial crime has been promoted to become the bank's new chief operating officer. And the reason it caught my eye is usually I would say you don't see folks coming up the compliance side and ending up at at a position like COO. And that is a new position created to move him in. So, and the announcement from the bank talked about unifying and centralizing their operations, but also bringing compliance to the same level across the entire institution. So, just interesting to see how different organizations are looking at the importance of compliance.
You noted something with Iran. Do you want to mention that?
Yes, Iran has taken some steps to try to get off the FATF blacklist. Their Expediency Council has conditionally approved joining the Convention for Suppression of the Financing of Terrorism. Back in May, the same council approved participation in the UN Convention Against Transnational Organized Crime. These are both significant steps for a country on the blacklist in its efforts to align more with international AML CFT standards and at least move from the blacklist to the gray list. Now, there was no comment by FATF, but as they do their periodic reviews, this will put Iran in a little different light. I don't know how much impact it'll have, but directionally, it's different than Iran has been for quite some time.
You also have something about Canada that we talked about briefly before we jumped on. You have an update there?
Yes, so FinTrack and the large Canadian banks are focusing on improving efforts to combat insider threats. And we've talked on a number of our webinars about the risk of insider threats in the fraud space. And in addition to fraud, these efforts are also working to ensure that the banks have adequate processes to ensure that rogue employees are not accessing bank records, particularly customer records that they shouldn't, and things like that. The article was interesting because there were several comments from folks in Canada indicating that this was an effort to make significant forward progress, even though they still view themselves as lagging behind Australia and the US in this area.
I have another international update. The Financial Services Volunteer Corps, FSVC, and early on in my career, I did some work with this group. It's a great group that helps around the globe in a number of important areas. They're particularly challenged now because of the change in U.S. government funded technical assistance. So they definitely accept donations, so something to think about. But their newsletter for September was just recently issued, and they have a number of things dealing with the spaces we care about. And I just wanted to highlight one. They're working on a project in Nigeria to deal with terrorist financing through crowdfunding. So they have an update there, and they say there's been a number of training sessions, and they highlight the fact that they're trying to strengthen Nigeria's capacity to combat terrorist financing through crowdfunding. And prevent the misuse of nonprofit sectors and that sort of thing. So obviously, this is an area that there's a lot of vulnerabilities with cryptocurrency and issues regarding financial inclusion. Take a look at that if you get a chance. These newsletters are free, and as I said, this organization is continuing to thrive, but mainly now through donations. But it's a group that I imagine a number of listeners to this podcast have participated in at some point in their career. So the FSVC, we get a chance, take a look at or potentially sign up for their newsletter. I think you'll find it valuable and certainly instructive.
John, I know you mentioned that you saw something about the Justice Department and reorganization that's proposed there. Do you want to talk about that?
Yeah, it was a Reuters story that I saw on LinkedIn, and according to the reporting, that the U.S. is scrapping a DOJ task force that looks at cartels, which seems counterintuitive given the fact that obviously that is still a major priority. In this reorganization is a plan to merge the nation's top drug and gun law enforcement agencies. And this is the most, according to the reporting, the most sweeping reorganization of DOJ in 2 decades. The Organized Crime Drug Enforcement Task Force is to be closed, and there may be a merger with DEA and ATF, but there's been some bipartisan pushback, so we'll see how that goes. So just something that I didn't see anywhere else reported, but we did see it in Reuters. So I wanted to just throw that out there for you to take a look at.
And the underlying explanation for the why was budgetary savings. I think the last big thing that we talked about before we started was a number of announcements by the U.S. federal bank regulators. You want to start there somewhere?
Well, there's a number of some were done. I can't recall now if they were all done together with the other agencies. I believe they were. So,
Well, I one
go
thing
ahead. You go ahead.
yeah, one thing that I noticed is it's the FDIC and the OCC, the ones that are joint, and the Federal Reserve does have a bank regulatory
Right.
element to it at the bank level, and they were not a party to any of these announcements. Now, whether these same announcements will come out separately from the Fed or not, they have not as of the time we're recording.
Yeah, and so before we mention some of the proposals, I also want to highlight there was an American banker story sort of related to this, and the story goes into the fact that the FDIC is operating with just three Republican board members and no Democrats. They're supposed to have five members, and so there's only three. Travis Hill, the acting FDIC chair, Jonathan Gould, the OCC, and Russell Vogt, the CFPB. So that's interesting. That's happening without all five members. So there may be some challenges going forward. We'll see. But one of the several proposals is to define, quote, unsafe and unsound practice, unquote, and to revise the framework in these agencies for MRAs, matters requiring attention, and other supervisory communications. There's another one that deals with eliminating the focus on reputation risk, we'll talk about in a second. But Elliot, is there anything you want to mention specifically about the one that's focused on community banks?
They're updating the definition of community banks, and the community bank and community thrift organization appears in regulations regularly, but the definition is being updated so that it will be institutions with assets less than 30 billion with a B dollars. And as I mentioned to you before we started recording, you and I have been in this business a long time, and a community bank used to be thought of as a bank that had branches in two small towns. And while $30 billion is not gigantic by today's banking standards, that's still a big bank. I think the point of the change is community banks are very different and less complex than the mega banks. I think when you get to 30 billion, you're pretty complex. So we'll see. I don't think it'll make a huge change. Some of these other changes are head scratchers for me.
Yeah, and the last one that we'll reference, unless you have something to add, is the prohibition on the use of reputation risk. So this is by the FDIC and the OCC. To me, I must admit, I think this is more performative than practical. We'll see what happens in terms of the comment process. But just reading from this, a 44-page notice for comment, and the part of the premise that's listed early on in the document says there's no clear evidence that interference in banks' activity or relationships in the interest of protecting the bank's reputation has protected banks from losses or improved banks' performance. It also then says this, in addition to not enhancing safety and soundness, again, their term, focusing on reputation risk, we can argue about the premise, can distract institutions and its agencies from devoting resources to managing core financial risks, such as credit, liquidity, interest rate risks, which are quantifiable and present significant threats. Of course, I agree with that. Monitoring requires dedicated resources. And I'll leave you with this next sentence. For example, in order to confront such risks, institutions frequently purchase expensive risk monitoring models that must be maintained, implement detailed loan review programs, hire expensive outside advisors, and provide time intensive training for staff. And they have limited resources to cover other areas. In the judgment of the agencies, examining for reputation risk diverts resources that could be better spent on other risks. That's, in fact, if you actually agree that agencies are examining for reputation risk. So I have seen some things, Elliot, on LinkedIn that's really interesting. So former regulators were commenting on this, have just raised a couple of questions about previous bank failures and other issues in terms of what is meant by reputation. I find this whole debate quote unquote, to be fascinating because it's going to bear watching. I've talked to a few of our friends in the industry, and they've done some things like taking the words reputation out of all the policies, that sort of thing. It's really going to be fascinating to see if there's any cases brought against institutions by the agencies or by the Small Business Administration, that sort of thing. A lot more here, but take a look at this.
The other one that I just want to mention is the OCC put out a bulletin. It's about model risk management. For those who've been around for a while, model risk management started out as something that was pretty narrow. And over time, the guidance expanded so that more and more things fell under the definition of models. And the new guidance from the OCC says that model risk management should be customized when applied by community bank management to be commensurate with the bank's risk exposures, its business activities, and the complexity and extent of its model use. And this next sentence I find to be very interesting. A community bank using relatively few models of only moderate complexity may conduct significantly fewer model risk management activities than a bank where the use of models is more extensive and complex. And that I 100% agree with. I think, though, that the complexity of the models you use may have something to do with your size, but it has much more to do with your product set and your customer set. And so it'll be very interesting to see if we see actions by the regulators related, or we start to see a trend within the industry of saying, we're going to only look at our non-complex models once every 5 years, which would, I think, be unusual today. Model risk management has been bouncing around as a difficult internal issue for banks for a while, and we'll see if this actually clarifies anything or just makes it more confusing.
Sounds good. I'm working on efforting a couple of interviews. I will say that Elliot was kind enough to review several papers from my students from our summer class on money laundering terrorism. And we've published on our website and on LinkedIn 3 final papers that I think you'll find interesting. We certainly did. We have a couple of interviews coming up in the next month or so. But as always, if you have ideas for themes, topics, or individuals or entities you'd like us to interview, please let us know.
Our next webinar is the 23rd this month at 1 p.m. And you should sign up for that. And John, enjoy your new granddaughter and give my best to Sue. And we will talk next week.
Sounds good. Stay
Okay.
safe.
Yep. Bye-bye.